All right, very good morning, everybody who just joined us. It is 9 a.m. right here in Hong Kong, as well as in Shanghai. This is Bloomberg Markets China Open. Annabelle Droulers is with me, Rishaad, Salamat.
Our top stories this hour: Asian stocks under pressure as Fed officials push back against bets on aggressive rate cuts next year. The Bank of Japan widely expected to keep the world's last negative interest rate in place, with investors left awaiting any hints on when that might change. And the US calling for Hong Kong to free former media mogul Jimmy Lai, with his national security trial set to begin. And Rish, of course, something we're really watching across the course of this hour, one of the highest profile national security cases that we've seen in the city today.
Yeah, I mean, you know, the thing is, Sebastian Lai, his son, has already said that this is actually a trial of what is really the moment the Hong Kong judicial system, including really the freedoms on trial here as well. Well, be that as it may, Jimmy Lai, outspoken journalist, entrepreneur here as well, of course, founder of the controversial tabloid Apple Daily. He's accused, of course, of endangering national security, and if convicted, faces perhaps life behind bars ultimately here as well. He's already spent 1,000 days in prison for lesser charges. So here we go, and we've got politicians in the West, US, China, sorry, US, UK, and of course Canada, really at the moment coming out in support of him.
Yeah, that's right. Any sort of conviction, of course, is something that really risks further undermining these tensions that are already in place. We've had a statement out from the US State Department this morning, for instance, saying that they're urging Beijing, Hong Kong authorities to respect the press freedoms in Hong Kong. Actions that are taken so far have really undermined Hong Kong's democratic institutions, harmed Hong Kong's reputation as well as a financial hub. So that's certainly some of the questions that we're going to be looking at over the course of these next 80 days. I think the trial is supposed to last as well.
Quite something here as well. But let's get to what is at the moment the run-up to Christmas. I mean, it's just a matter of a few days away now. And what have we got in terms of the assets and how they're behaving themselves? Looking at there we go. We've got Nikkei 225 off the pace by about 1.1%, seeing stocks just under a little bit of pressure. And just looking to what's been being said in the US about rates in particular. ASX in Australia under pressure here as well. And the Kospi, of course, we're awaiting what happens with the Open here in Hong Kong in a little 28 minutes from now. Of course, there is the pre-auction period getting underway at, well, now. And, of course, we get a price at 20 past. So US shares are really at the moment ended a 6-day rally. We've got the Fed pushing back against these bets of aggressive interest rates coming next year. We've had, of course, several members of the Fed, President John Williams coming out as well. Of course, he's from the New York Fed, saying it's too early to begin thinking about rates, but other people have also been weighing in. Yeah,
well, one of them, of course, is the Chicago Fed president. He was speaking over with local media, or CBS Face the Nation, over the weekend, and he spoke about how the Fed is really going to be battling with inflation and, again, as you said, really pushing back on those expectations of imminent cuts. Take a listen.
2023 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. We got to get inflation down to target before, until we're convinced that we're on path to that. It's an overstatement to be counting the chickens.
Right, well, let's get a sense of what really is going on in terms of the heartbeat of the market. Mark Cranfield from MLive joins us now, as does indeed Saxo Creator China market strategist Redmond Wong. Mark, let's kick things off with you. It's quite something that they're just pushing back now, given what the dot plots are suggesting last week.
Yeah, I think traders will consider that to be a very mild pushback. You've heard from the chairman of the Federal Reserve, and the way that investors look at these things is that the top man, Jerome Powell, he carries more weight than anybody. Very clearly last week, especially during his press conference, he clearly made a more dovish than expected outlook for financial markets, especially for the US markets in 2024. That is what investors are focused on. That's where they're positioning themselves going into next year. That good mood is likely to last well into January. You may have had a couple of Fed other voices pushing back a little bit. Traders will not be alarmed by that. They'll expect it. Probably even Jerome Powell probably doesn't really want to be forced into an interest rate cut in March. He'd probably like to wait a little bit longer, see the inflation a bit closer to his target. But the die has been cast. Investors are getting used to the idea that interest rates will fall next year in the United States. That's going to be a big input for global markets, for risk assets everywhere, bonds, currencies, everything. And just because you get a few Fed speakers, and there'll be a few more Fed speakers, no doubt, who will push back a little bit, especially on an early rate cut. But the idea is, and the dot plots justify it, rates are going down, and that's what traders and investors have clearly heard.
Yeah, so Redmond, to your view, is this really just about sort of managing expectations now?
Yeah, exactly. I think, number one, the Fed is really, doing policies on consensus. So it's actually that within the FOMC, they came to consensus, and the Powell actually tried to get consensus. So what they are trying to do is just have different voices to prepare the market, and at the same time, is they want to keep some flexibility. So the Fed themselves have done a lot of research on how actually their talking affecting the market reaction. So they know that actually the talking part is part of the tool in their toolbox. Is a tool that you are using. So deliberately, I think they want to do that, give different voice and prepare the market at the same time, not still maintain some control. Yeah.
Of course, inflation doesn't just go away, does it? That's the thing. And the question I want to really get to here, what evidence do we have of what they've done so far in the aggressive rate hiking cycle is playing out now? Because you could argue that inflation is actually coming down irrespective of what they've done, because we've seen that happen in some countries elsewhere. So that begs the question, does monetary policy here matter, and is it working? And the thing is, by the same token, did QE work? Because of the delayed reaction that we're getting. It's a fundamental point here.
I like that question, but that actually is for 2 hours.
Yeah.
But exactly, I think you got it exactly right. There is a lot of pushback and say whether the Fed can give themselves a pat on the back for the decline or inflation. Inflation will come down, and without the Fed having done all those tightening. But that's a really big subject. But having said that, okay, let's just assume and monetary policy work as they supposed to work, and so we can see, of course, is some slowing side, for example, some difficulties on the medium size to small size company in getting finance and rolling over the debt. The bank has tightened the lending standard, and also the consumers actually probably also paying a much higher consumer credit rate, and we are seeing some early start problem on that already. So actually we are in the camp that's saying that the economy finally may be at risk to running into a recession next year in the U.S. Much belated, but it was coming, yeah.
Hi, Redmond, it's Mark here. Assuming that the dot plots are correct and that interest rates do decline next year in the United States, and that probably means a weaker US dollar, which of the major currencies would you favor to do well in 2024?
I think we like the yen quite a bit, and so we think that the ECB and BOE, despite what they are talking right now, they are going to cut rates, and also very quick. So the Fed and the ECB and the BOE, they are cutting. So and the BOJ, even though we don't expect them to actually to do anything this week, and they probably will, make the move in between January to March. But they are, I think, probably still we will be seeing flow into Japan, and I think yen will be good. And renminbi probably we have seen the weakest point for the time being, and will tend to be also supported. And also some Asian currency may do well as well, like Korean won and maybe Kaffa.
And how about in the rest of the world? If the Fed are lowering interest rates, do you think that will push the European Central Bank into an earlier rate cut, or the Bank of England, or are they going to hold back as long as they possibly can?
I think their economy, especially the Eurozone, the economy is not doing well. We think that they will move quick despite what, all the rhetoric they are talking about at the moment.
I'm interested, though, because if we still see inflation sort of struggling to drop below 3%, what does that tell you about the trajectory of Fed rate cuts as well?
I think they better do it quick, because now you have the window of opportunity. The momentum, the 3-month annualized rate has been decelerating. So they actually can use that. But I agree. I mean, actually inflation rates have difficulty to go below 3% or stay below 3% for a long time for a number of reasons, like fragmentation or global fragmentation, or also the green transformation. They're all inflation. And back to your earlier question about whether monetary policy works, there's actually theory saying that, it's like Thomas Sargent, the famous economist, right? I mean, he has written extensively on studying the hyperinflation in the past is under a fiat currency system. I mean, the key actually to bring inflation down is a fiscal deficit. I mean, you need to have lower the fiscal deficit to keep inflation at bay for a long time. But by the end, the value of the money for a fiat currency is the ability of the government to tax and to run surplus and to repay the debt.
Well, good luck to anybody who wants to do that in an election year, right? I mean,
yeah.
I mean, let's not forget politics here, right?
Yeah, so that is, I mean, there's so much the Fed can do and try to keep the inflation rate down, But if the fiscal deficit actually running away, and yeah, it's very difficult to keep inflation at bay. Yeah.
Hi, Redmond again. One more. On the Bank of Japan next year, let's assume they really do tighten policy, they get out of negative rates. Do you see them raising interest rates up to 0.25 or 0.5%, or are they just going to stay at zero for a longer period?
I think they need to do the YCC first, and then, yes, they will back to... I mean, yeah, that actually chance they can move back to 0.25, but that will be later, at least after March. I mean, it's April or in the second half.
So, Redmond, where does this all leave, actually, your strategy looking ahead? I know you're mainly concentrating on China, but, you know, what does it all mean for the investor?
I think that the stock market, given the anticipation of rate cut, and actually I think the investors are correct, and actually the market has not priced in more than actually they should. I mean, there's still more room because we think the Fed will cut very fast and very early. And so there's still something left in the stock market over the next few weeks. But January, February, that we are worrying is that some of the, I think also this morning you talk about Bloomberg about the earnings forecast, and actually earning and margin probably will get hit as the economy slows down in the first quarter. So we think that we worry that it may be more bumpy in January and February. But at the moment, I think there's one thing. So we want to, going into the first quarter, we want to be a little bit more defensive in stock. And go for don't get out of stock or completely, but get to the defensive sector. And then on the fixed income, I think it's still a good place to be in, and the curve will steepen. Even though we think that the church inflation may actually difficult to remain below 3% for a long time, but at the moment, especially the short end, the yield is very attractive.
Redmond, please stay with us because we've got a lot to discuss. We're going to talk about China and whether we can see a bounce back there as well as in Hong Kong in 2024. Signs aren't looking great at the moment, but you never know. There we go. More coming up from Redmond, but let's tell you what else we have on the way. Former media mogul Jimmy Lai is set to go on trial right here in Hong Kong. It is a highest profile national security case to date. Details coming up on that.
And we're counting down as well to the open of trade in Shanghai, Shenzhen and Hong Kong. Taking a look outside the courthouse ahead of Jimmy Lai's security trial, this is certainly one to watch over the coming 80 days or so. More ahead, this is Bloomberg Markets, China Open.
Okay, getting the fix of the Chinese currency here, and it is stronger than anticipated. We were looking at a number of about 7 yuan 11. We got 7 yuan 9. That is what we have at the moment. Of course, the PBOC did on Friday offer that record $112 billion in cash, really, to provide liquidity and also just give perhaps a little boost to the economy. And talking of China, we've got Greater China Market Strategist at Sachs still with us. It's Raymond Wong. Raymond. Okay, what happens in 2024? We've got property still likely to be a big overhang, but let's not forget the other things that are having to face up. We've got massive debt. I'm going to call it the three Ds. A debt, the decoupling story. On top of that, of course, demographics and an aging population. These things are really medium and long term that they have to face up to. How does this play out next year?
Yeah, I mean, I start for the last one. I mean, demographics really has been a problem for China And so you need to, I think something they can do probably, is the retirement age in China a little bit early. So you can actually extend that. You can, keep the labor force there. And then also there is also a lot of training or upskilling for the working force in China. Because education, despite what you see from the result from the kids in Shanghai, it looks very stellar, but for the majority of the population, the majority of the workforce, the education standards actually is still quite low. And because in the rural area, they didn't really got the proper education. So that's something they do. And then on the property market, yes, it's a big overhang. And so the government probably have to do engineer some restructuring on that, but that will only solve part of the problem. I think that the key thing is still to enhance productivity and give back confidence to the private entrepreneur, and then to improve productivity. That is actually the longer term challenge, and that is actually the most difficult.
I'd say we're at peak bearishness, but we always seem to be able to go a leg lower. So how many of those risks have been priced into Hong Kong or mainland equities in general? And are you at all optimistic given those risks that you just mentioned?
I think two things. For longer term, medium to longer term, structurally, we are still wait and see, because it's all those structural headwind. We have not seen actually any solution or any major initiative to really to address that forcefully. Given we look at some of those readout or statements from the meetings in the fourth quarter, and pretty much is the policy pretty much stay in put and basically not a whole lot. And also the very important third plenum and the plenary session, and that is going to set the economic development strategy for the next 5 years. That was delayed. Usually it would be October, November, but it has been delayed, and that's every 5 years. That's most likely now will be on the first quarter before the two sessions. That is very important, because that is the one define the next 5 year strategies. We are wait and see for that. Short term, maybe that's a very bound cyclical, but longer term, we have wait and see. Yes.
Redmond, and we've got a board of these ratios here, price to earnings here, and to Annabelle's point about we reached peak bearishness and it always seems to be another leg lower. But let's put it in a more historic term here. We had perhaps investors overly bullish in China for a long time. Now they perhaps, would you argue, that they are now overly bearish on it? And if they are, they perhaps still look for some opportunities. And how long does this overly bearish period last for? Because we've had quite a lot of it so far.
I think I would say, of course, this is only estimate. The bullishness is very difficult to but now they are, overall it's very bearish, but whether that is at extreme is that's still difficult to tell. We haven't really seen the kind of panic capitulation sell for many investors yet. And some of those who bought earlier of these years, especially foreign investors, they might have retrimmed those already. And overall, yes, now the mutual fund allocation, like global active fund, probably talking about 6.6%, around 6% allocation to China, Hong Kong, and at the peak, they are around 15%. So they will lower down quite a bit. But for domestic investors, for other type of investor, whether actually there's panic selling, we haven't seen that yet. So we haven't said that valuation is attractive, but valuation is not enough. We need some catalyst. So we hope that we can see that in the next quarter, but I think we'll wait and see whether actually we see better policy there.
When it comes to the catalysts, because you're talking about promoting growth, promoting private sector, entrepreneurial spirit, but you're also referencing as well the challenges given that Beijing is such a state-led market as well. How do you really square those up over the longer term?
You have to strike a balance. It's always, in China, it's always when the economy not well, they try to give a little bit more freedom to the private sector so that can give bring some energy to the system. But so far, what we are seeing, like recently in one of the articles from the Droulers, and that is the party mouthpiece, actually that we quote what President Xi said on the conference, the Central Financial Conference. The whole thing is talking about Marxist theory on financial system. And he mentioned the term risk 23 times, but he mentioned nothing about property market, actually. So it's more like a control and containing financial risk. So I think that now that the focus is a little more on control side. What we want to see in the third plenum, if we can see they go back to the playbook of 2013 in the 18 Central Committee for Plenum. They talk about marketization, more opening, it's a private sector. That will be the good side longer term for China, but we still yet to see that.
All right, Redmond, thanks very much for your time this morning. That was Redmond Wong, market strategist at Greater China at Saxo. Just a stock, because we're just into pre-market trading here for Hong Kong, and SenseTime really plunging here as we get underway. So off around 20% at this point in time. But sad news over the weekend. The founder of this firm, SenseTime, it is sort of considered a market leader in computer vision inside China. One of the first companies as well to be able to roll out its own version of ChatGPT, or its competitor to that service. But essentially that stock here plunging after its founder, Tong Xiao'o, died on Friday after an illness. More ahead. This is Bloomberg.
Here we go. This was a scene Saturday morning around about 10:30, 10:45 in Hong Kong over Victoria Harbour. This was the first visit of this Chinese-built single-aisle plane, the Comac C919, flying over the city. It was really something which garnered quite a lot of young people to watch it, actually. And we had, of course, the government saying that Hong Kongers could experience a major milestone in Chinese aviation. There we go. But those planes left, of course, on Sunday. We had, of course, an ARJ-21, which is not indigenous, but is made in China. 6-day visit from last Tuesday there, coming to an end. Here we go. Markets opening in less than 5 seconds now.
Yeah, looking red across the screen once again. So the start of trading here, really one of the last couple of weeks of the trading year for 2023. And the outlook for Chinese stocks over the course of this year has just been sheer underperformance. And quite interesting, because you were to think about where we were 12 months ago, it was certainly a very different picture and a lot more optimism coming through. But so far in the session, what's really declining, you can see, is we've got the tech stocks down around 1% as we get trading underway. Also some weakness coming through in the iron ore space as well. That Dalian contract down around 2.3%. So that's really a picture perhaps of the concerns around growth that continue to build in the Chinese economy. So the broader index of 1% for the Hang Seng at this point in time. Let's change on, take a look at what else we're seeing in Chinese stocks as we get underway this morning again. Every single sector here is in the red.
Every industry group here, all of them.
Yeah, quite of course. You really can't say bearish sentiment enough when it comes to Chinese stocks over the course of this year. There are a couple of movers, though, that we're really keeping a particular eye on this morning. So SenseTime is one of them. This is sad news really out on Friday, but the company confirming that the co-founder, Tong Xiao'o, died on Friday. That was after an illness. SenseTime, of course, it's been seen that really as one of the leaders in computer vision inside China. Yes, it has really struggled with geopolitical tensions, but still at the same time it was the first, or among the first, Chinese tech firms to receive government approval to publicly roll out its own ChatGPT-like service. So seen as a really key beneficiary in the AI space. But as I said, its co-founder passing away on Friday, or confirmation of that. Let's change on, because there's more stocks that we're keeping an eye on this morning. There's XPeng, of course, that's the Chinese EV maker, and you can see here that big drop here, down nearly 6%. Alibaba has announced a stake sale in the company worth just under $400 million. So a signal that Alibaba is really serious about shoring up its focus on revitalizing the business and turning back to the core interests of the firm as well. And just finally, taking a look at another tech group of focus of tech stocks, that's Apple Supplies here, because we've got China, or signals that China is expanding its iPhone ban. We have already seen that sort of being in place, but it's now being rolled out to more firms across the country, more regions as well in focus. So you are seeing here those Apple suppliers declining off the back. So Rish, as you said, really not a great start to the trading week again.
No, okay, but yes, no Santa rally after last week we saw in various parts of the world. But Winnie Wu is going to try and make sense of all this. He's from Bank of America, or BofA, a securities specialist, China equity strategist. Winnie, great to see you as ever. Now, you call 2023 in hindsight from risk on to risk off. Will we in 2024 have takeoff? And if we do, what's going to make it happen?
Yeah. So at year end, a lot of people are reflecting what went wrong and how come market came from, risk on. Everyone thought that 2023 will be a great year for the China equity market.
Until January, mid to late January, and then suddenly the alarm bells went off.
Right. So, in my view, equity market is only a reflection of the underlying economy. So, if you look at the Chinese consumers' household, if you look at Chinese corporate, they also didn't take on any risk. In fact, they were in the risk-off mode, right? Consumers saved more, spent less, invest less. Corporate are also not doing capex. And why is that? I mean, I guess overall, the policy direction focuses a lot on risk control, on, handling the systematic risk, on anti-corruption, on security, but maybe not enough strong message in terms of encouraging innovation, tolerating failure, accommodative culture, right? So I guess for 2024, whether we can change from risk off to risk on in the market, also come back to the policy direction, to the government focus of the economy.
So what is the policy focus? What does it need to be to try and spur that turnaround?
Yeah, so in the latest Politburo meeting in December and also the Central Economic Working Conference, there's more emphasis on economic progress on top of stability. So seems there's some awareness that they need to continue to focus on development, because I guess the key experience in China's success in the past 20, 30 years is we solve problems during the process of continued growth and development, right? You keep growing the pie, then a lot of the problem risks will be naturally resolved. But I guess in the past couple of years, there's overemphasize on the risk control, but not enough emphasis on growth, on innovation. So let's hope that, from the December Politburo meeting, from the Central Economic Working Conference, we'll see more accommodative policies, right? More encouragement of, entrepreneurship, risk-taking behavior, on tolerance of the failures.
I mean, the language coming out of, the working conference, quite something here. I mean, emphasizing regulation, and then at the same time, as you say, they should also at the same time be emphasizing entrepreneurial activity and innovation. In other words, animal spirits. It doesn't help, does it, this kind of narrative that this is the thing?
Yeah. Well, in the policy paper, it also said better coordination of the policy directions. Right?
Exactly. I mean, and saying that this should be targeted in heavy-handed clampdowns. I mean, this is another the quote out of what they're saying. It's not exactly wanting you to go out and do something entrepreneurially.
Yeah, exactly. And I guess that's why market has been selling off in the past few weeks, right? I mean, look at the reasons for market sell off. There were the year-end redemption pressure. There were reasons from the deflation, deterioration in macro data. But I guess it's also responding to these heavy-handed clampdowns and very tight regulations. So hopefully we'll see some softening of the tones and more encouraging signs.
But there's policy direction on the one hand. I think for an individual, if you're someone who your house is worth less now,
exactly.
your stock portfolio is also really diminished, possibly your salary is being cut or your bonus doesn't look that great.
Yeah.
What kind of time frame do you really expect to see some sort of turnaround in? Because there is that lag of policy, and then you've just got really very weak sentiment.
Yeah, that's right. So we're probably not talking about months, but at least a few quarters, right? And on the property side, I think, there's also the awareness that currently the policy focusing on ensure project delivery, project completion, which is necessary but insufficient. Right, people are not going to buy a house if they worry the house will not be delivered. So ensure project completion is only one side of the equation, but also on the other side, you need to give the people the confidence that, okay, property price will not keep falling, that you have some visibility on your job or income outlook, right? So, managing expectation on property price outlook is also very important, especially in the major cities, right? In large cities where there's still incoming of young talent, where there's still, jobs, then, property price, they need to manage expectation that property price shouldn't keep falling.
Yeah, Winnie, I mean, we're talking about the wealth effect. If you're poor, to Annabelle's point. So where does that leave what your strategy is? And does that mean people, as consumers, trade down? And have they been trading down? And is that part and parcel of what you're thinking, or what's the deal?
Well, unfortunately, I think the consumer sector is still a very challenging outlook, right? The consumption
So
downgrade
where's the bright
continues.
spots then?
And also, I think from position holding perspective, they are still relatively well owned among global funds, right? Global funds sold their China banks 10 years ago, sold their internet 2-3 years ago. The last position they're holding are some of the consumption stocks, right? Supposedly, they are less exposed to geopolitical tension risk, that they have a long-term structural story. So position-wise, it doesn't really help consumption stock. So in the near term, until the risk-off environment change, I think we're still favoring, defensive yield stocks. But also on the other side, given the pie is not growing as much, we need to focus on companies that can gain market share, whether domestically from, the localization policies or externally that companies can expand in the global market.
To understand again that time frame of when you start to see some sort of sustained pickup, you said a couple of quarters at least.
Yeah.
What is your expectation? When are we going to see that really kicking in? Is it even in 2024?
Maybe later 2024. I guess external environment, when Fed start to cut more decisively, it will give China a bit more policy room, right? And a few quarters down the road, if people see there's a stabilization of asset price, property price, it might help with the household negative wealth effect. So it might be a later 2024 story.
All right, Winnie, thanks very much for your time this morning. That was Winnie Wu, China equity strategist at BofA Securities. Turning now to what's happening in Hong Kong today, because an important trial starting. It's the US as well, off the back of that, urging Hong Kong to free former media mogul Jimmy Lai as he faces charges in the city's highest profile national security case to date. For more, let's bring in Bruce Einhorn here. Bruce, talk us through exactly what the charges are against Lai.
Sure. So Jimmy Lai, of course, many people in Hong Kong all are familiar with his situation. He's been in jail for over 1,000 days now on other charges. He's now facing the most serious charges, which could leave him in jail for the rest of his life. Those include conspiring to collude with foreign forces to sanction, blockade, or engage in other hostile activities against China and Hong Kong. He's also being accused of conspiracy to publish seditious material. The first charge about the collusion, that's under the national security law imposed after the 2019 protests. The sedition charge is under a law dating back to the colonial days.
Yeah, that's the sedition law, of course, which is in place in various, actually, ex-colonies here as well. But, of course, we've had his son, Sebastian, going around and talking about this case, saying that it is Hong Kong on trial in itself. It's a legal system in trial. What's been the reaction from what we've heard, of course, from the US, and what about the UK, Canada, and others?
So, according to some people familiar, there are going to be at least 3 consulates here in Hong Kong that are going to be sending people to the trial to observe it. As far as reactions from foreign governments, the Canadian Parliament unanimously passed a resolution this past week calling for the release of Jimmy Lai. The U.S. government has called for the release of Jimmy Lai. UK Foreign Secretary David Cameron said in a statement that this trial, putting him under trial under the national security law, that this is a violation of the agreement between the UK and China related to the handover of Hong Kong back in 1997.
It's not sending the right signals out, is it, if they want to make, I suppose, underscore Hong Kong as a financial hub here, which they've argued the national security law does do?
Well, yes, the national security law is something that, at the moment, has a 100% conviction rate. So, not to say that it's guaranteed that Jimmy Lai gets convicted here, but if you look at the precedents up until now, the track record has been pretty clear. This is a law that works to Beijing's satisfaction.
Bruce? Thank you so much. Bruce Einhorn there, just having a look ahead to this trial of Jimmy Lai, which is moments away apparently from starting right here in Hong Kong. Let's have a look at some of the geopolitical stories that we are following for you, looking at Russian President Vladimir Putin, because he's saying he has no intention of attacking NATO countries, saying that Moscow has no territorial claims of the bloc's members. Putin's comments coming after President Biden said that Russia would not stop at Ukraine. The White House trying to convince US lawmakers to release some $61 billion in military aid to Kyiv. It's been held up in a dispute with the Republicans over border security. Egypt saying that it's monitoring tensions in the Red Sea, that as Yemeni militant attacks prompt ships to avoid the area. Assaults have increased in recent weeks as Houthi fighters target vessels the groups say are connected to Israel, and that's in response, of course, to the war in Gaza. Several major shipping lines saying that they're pausing voyages on the Red Sea. Of course, it is one of the most important trade corridors in the world. Talking of trade corridors, the Philippines saying that it's seeking more military agreements with other nations that would allow joint training. Now, on a visit to Japan, President Ferdinand Marcos Jr. said Manila was looking to boost alliances, as all amid heightened tensions with China over the South China Sea. A series of encounters in recent months have included Chinese ships ramming and blasting water cannon at Philippine vessels.
Well, coming up, the relationship between Hong Kong's property developers and bankers could be put to the test, with billions in loans due next year. We'll have more details on that ahead. This is Bloomberg. Ivanhoe Mines founder Robert Friedland says copper prices need to nearly double to stimulate the industry into building new mines. In an exclusive interview with Bloomberg, he says he expects strong demand from China going ahead.
So everybody, when they think of China, they think of the real estate sector, but actually it's a much broader economy than that. And their solar, their wind, their new energy developments are massive.
So what do you think the demand pull from China is going to be like next year?
I think it's very healthy.
Okay.
You see, physical inventories are incredibly low. Chinese smelters are scrambling to find feed. The tolling and refining charges in China are down very, very sharply, meaning they're very hungry. The smelters are very hungry. So the miners are having trouble supplying enough copper concentrate to keep their downstream refining capacity full. And that's actually a global issue.
Robert, Morgan Stanley thinks that copper is going to go to 9,000 by the second quarter. How does that sound to you? Is that a realistic price target when it's at about 8,500 right now?
That's more or less a consensus view. I think 9,000 is sort of middle of the road. Hard to argue with that.
Is that going to disrupt demand? Is it fine? Is that all right? Will it be cost sensitive at all?
In order to build a new mine,
the demand is going to be really strong.
$9,000 is not enough per ton to stimulate the industry to take the risk to build huge capital-intensive mines, especially in Latin America. The traditional giant porphyry copper mines, they're $5 to $20 billion each and 15 to 20 years of work. So we probably need $15,000 a ton, stable for a long period of time before the industry can really gear up and build those giant mines.
Wow. That's all.
Yeah, I mean, we have seen that, right? Like copper supply disruptions are rising rapidly, Robert. What does the supply picture look like in 2024? Will it tighten even further?
You know, if I hold a telephone book out here at the end of my arm for an hour, I can do it. But after an hour, if you put a feather out there, you'll break my arm. So markets are made at the margin. We've just lost about 3% of the production from disruptions in Panama and some mines in Chile that are late. And that 3% is enough to take all the slack out of the market. So we're in deficit already. And as the Fed weakens rates in an election year, almost any additional disruption can cause a very, very, really sharp upward spike in prices.
That was the Ivanhoe Mines founder Robert Friedland speaking exclusively with Bloomberg. Interesting, of course, he's very optimistic on the outlook for copper.
Well, he would be, wouldn't he?
Demand from China as well. But actually, when you take a look at what's happening so far in the commodities complex, we're pretty much risk off here across the board this morning. The big mover we're seeing so far is aluminium, or iron ore rather, the Singapore contract. We're back down 2%, so around that 131 mark. Of course, are still historically elevated levels, but weakness coming through. So an expression of what we're seeing, concerns around the growth outlook as well. Otherwise, again, it is pretty much red across the screen here this morning. The moves are fairly muted, so not too much direction coming through. And we can also take a look at trading volumes as well. A lot of traders probably already on their break for this year, but a bit of dollar weakness coming through, or dollar strength rather. We're seeing some currencies declining off the back, and as well weakness coming through in the equity space. But it's the Nikkei here that's really the standout, down 1.2% at this point.
Okay, let's quickly just check on some of the individual movers, and sad news about Sensime as well, plunging here, 8.7% after the death of the company's co-founder, of course, AI company here as well. Looking also at Xpeng, 4.6% to the downside here. Why? Well, we've got at the moment Alibaba disclosing a plan to cut its stake in this EV maker here as well. Now, looking at what we have with Xpeng, its shares actually on Friday did fall back, I think, around about 8.5%.
Yeah, on the Wall Street session.
Exactly, that's what we had there. Sunny Optical, various Apple-related companies also not doing great because of the extension, perhaps, of iPhone bans in parts of China amongst government officials, and then the expansion of already announced policy, if you will. And there we go. Let's have a look at these markets overall in China.
Yeah, it's interesting. I think to your point, though, that iPhone ban just tells you perhaps geopolitical tensions, and that's really been the key reason investors have stayed, or one of the key reasons they've stayed away from Hong Kong and mainland equities over the course of this year. They're unlikely to dissipate over the course of 2024. So that bearish sentiment that we're seeing likely set to continue for a period at least. That's it for Bloomberg Markets China Open. Bloomberg Markets Asia is next.
All right, 10 a.m. here in Hong Kong as well as in Singapore, 11 in the morning in Tokyo. This is Bloomberg Markets. I'm Rishaad. Salamat with Annabelle, Droulers.
Our top stories this hour: Asian stocks under pressure, Treasury yields little change, but Fed officials pushing back against bets on aggressive easing next year. The Bank of Japan meeting getting underway, with policymakers widely expected to retain the world's last negative interest rate. Plus, more Chinese agencies and companies order staff to stop bringing iPhones and other foreign devices to work.
Absolutely. We've been looking at those Apple-related shares in this neck of the woods, and not having a pleasant time of it, of course, naturally, as you'd expect from that. Looking at markets overall, it's certainly a day where we are just... I suppose just taking stock, if you will, and just getting a bit of a risk, not really taking on any risk here as well. The index overall for the region down by just about 1%, and just to say that it is a broad-based fallback here as well. We got, of course, that the US shares ended that six-day rally, and it's the Fed, isn't it, now, again, which is partly responsible for all that, because... I guess, you know, we've got John Williams and others there at the moment suggesting it's too early to really be thinking about lowering the cost of borrowing. And that goes, well, it's a loggerheads with what Jay Powell had to say after the FOMC meeting, of course, on Wednesday.
Yeah, that's right. Really setting those expectations. We were going to see a dovish pivot over the course of next year. You had traders really agitating for that, confirming their views. And then that sort of pushback, as you said, that started to come through on Friday. We had Williams over the weekend as well. We heard from the Chicago Fed President Austin Goolsbee, and he spoke on CBS Face the Nation. Take a listen.
2023 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. We got to get inflation down to target before, until we're convinced that we're on path to that. It's an overstatement to be counting the chickens.
So the market reaction that came through that, we saw yields just moving a little bit higher, but of course a big drop over the course of last week as well after that Fed decision that came through. But broadly in the session so far today, the action is really coming across so far concentrated in the equity space. That's where we're seeing the biggest moves here. The Nikkei, for instance, you can see down 1.2%. And also some moves that are coming through in the commodities space, for instance. Iron ore we were discussing as well, those moves in metals. So perhaps some concerns that are really feeding through around the growth outlook. And you have seen that dollar strength as well coming through because you've got some weakness coming through in Asian currencies so far-ish.
Absolutely. Let's get more on all this and how it all fits into perhaps a longer-term picture of an economy, globally speaking, which is evolving.
Yeah, that's right. I mean, we've got Matt Egan here joining us, portfolio manager and co-head of the full discretion team at Loomis Sayles, usually based in Boston, but here for a couple of days as well. So thanks for joining us in studio this morning. But your reaction so far to what came through, what we heard from Powell, that sort of pushback that came through, is that really a strong pushback in your opinion, or is it really just sort of trying to manage traders' expectations a little bit?
I think they're trying to manage expectations. They're trying to guide. I think the danger of the Fed is if financial conditions loosen too quickly here because they've done a lot to bring inflation down. They're sitting in a pretty good spot. We expect inflation to continue to decline over the course of 2024. Say by June of next year, we see it around 2 3/4. This is going to give the Fed, though, the ability to bring down some rates. So, the market is definitely looking through that and what Goolsby's saying and say, you are going to be cutting pretty soon. So it's just a matter of time.
Matt, I mean, we just came essentially back to where we were before 15 years ago, before that. I mean, this is the old normal. Okay, so get used to it. This is the thing. And, everybody's putting their hair out, but it's not going to be zero interest. It's not going to be free money anytime soon again.
That's right. I mean, QE is behind us, and I think this is a normalization of where yields are going to exist. The other thing is to think about is that structurally inflation is likely to be more unstable than it had been 15 years ago. So we're going to be fluctuating in wider bands. The important thing to know now cyclically is inflation is bottoming. I like the intermediate part of the yield curve to play that, but for longer dated treasuries, most of that upside has already been earned in the fourth quarter of this year. So there's not a lot of upside to treasury bonds from that perspective. But for the cycle now, what it means is that people can now pivot and be more aggressive in the way they're investing, particularly in the risk markets.
But if inflation is facing structural challenges, then do you really think that 2% is still the realistic target?
It is not. So I think what matters more, about rather than when the Fed starts to cut, is by how much cumulatively they'll get to. And I think I'm sort of, thumb of the wind will be something around 3.5% area. So if you're at 3.5 and the curve is, say, 2s, 10s is something like 50 basis point upward normal sloping market, you're still talking over 4% for the treasury market. And where are we today? We're still a little bit below that. So there's not a lot of room for yields to come down lower. Momentum-wise, maybe you're at a 3.5% when all is said and done, but I think you're going to be looking at a trading range for treasuries here.
So what's the deal here for credit spreads? I mean, up to a week ago, we had Asian credit. The spreads were actually, I think, at record lows. But in the rest of the world, we've seen this tightening. How long does that go on for?
Well,
and does it present any kind of value for you? That's the thing.
I think this is a carry market. So capturing that spread, I think, is going to be important for fixed income investors going forward. So you think about it, for a while now, investors have been really parked in the short end of the curve, certainly in the U.S. People would ask me, why do I want to give up a 5+% T-bill? Well, you do want to see that. You do want to do that when the Fed starts to pivot, go down. You're going to be reinvesting at a lower rate. So yields are going to stabilize here. Now people are going to be interested in, where do I get spread? For the credit markets, I think losses are going to remain low. The spreads might look optically tight, but that premium you're going to earn and keep is pretty attractive, and compounding that is a pretty attractive arithmetic for bondholders.
What about the carry trade in FX? Because this year really was the year of carry. Is that something that's going to persist over the course of next year?
I think it is. And I would say that it's going to exist in the EM side again this year. So you can get high single-digit yields, even up to 12% yields in currencies like the South African rand, the Mexican peso, the Brazilian real. Those, I think, are going to benefit from a reliquefaction of dollar liquidity in the global markets, again, from the Fed. They have room to cut rates, but without really damaging their currencies because real rates are so high. So I would stay along those currencies as well.
Yeah, and Matt, I mean, okay, we've got long-term changes. The economy, global economy is always evolving, but we've got certain new, perhaps, or newish trends here, which include the 4Ds, the decarbonisation, the demographic challenges that we face, also debt on a structural basis, and on top of that, decoupling. So, these are things which are going to be making the consumer pay for them ultimately. And so monetary policy, how does that play a role in this?
Well, I think it's going to lead to higher inflation over the long run.
That's the notion behind it, isn't it? It's going to be elevated.
With cycles, though, right? So this cycle is played out. I think you're likely to see higher highs and higher lows for yields on a cyclical basis, okay? And so, like, all of those factors are going to put an upward bias to inflation over time. It's probably going to contract the business cycle. And so for investors, you need to be active. You need to be thinking about where are we in the cycle, and the recognition is that you're going to be higher for longer and play.
You could throw another D in there to contradict that, and that's digital, which may well make things cheaper, if you will.
Yeah. So like for example, on the demographic side, we expect the demographics globally to keep wages tight, supply of labor tight. However, AI, that could be, if you get a lot of productivity, maybe you're back down to low 2%. Permanent inflation. I don't think that's the way to bet, though. I think those structural factors are going to keep underpinning higher yields and higher real yields. And so for looking at the 10-year Treasury, I think you should get a 1.5% to 2% real yield with about a 2.5% inflation premium. That gets you over 4.5%. That should be your base, and you fluctuate around that through the cycle. And
no matter where real yields are, but we'll talk about all that.
Okay.
Okay. Matt, staying with us, Matt Egan from Loomis Sales. Let's have a look at what is on the agenda for the week ahead. And just taking a look, of course, we've got the Eurozone out with inflation figures, minutes from the Reserve Bank of Australia's last meeting there as well, seeing the next day. Well, I got Japan trade. LPRs as well out of China for 5 years, and of course up there as well. I can't see, but we of course have the Bank of Japan's decision on interest rates. There we go. That's on Tuesday. Of course, I've missed out that one. And GDP out of the US. Those numbers are going to be keenly watched for, as will indeed Japan, inflation, and the Fed's preferred measure of what's going on with inflation, and that's the US core PCE.
But fairly quiet, I guess you could say, overall.
Yeah, exactly. It looks busy, doesn't it?
Yeah, end of 2023 trading, but still ahead on Bloomberg Markets Asia. Something that is being very well read this morning on the terminal is looking at JP Morgan's still hazy succession plan. JP Morgan, or Jamie Dimon rather, marking the halfway point of a special incentive offer. This is Bloomberg.